Welcome to our first quarter review of what's been going on in the investment markets. And I've got John Jones with me again, who's one of our portfolio managers from 24/7 Investment Management. And it's pretty fair to say that a lot has happened over the last sort of 6 months, which we're going to review. And we're going to sort of start at the beginning. So we're not going to get to the impacts of some of the more recent political issues and geographical issues. We're going to focus firstly on what sort of happened beforehand. So welcome back, John.
Good afternoon.
And let's have a quick overview of what sort of happened between about November and early Feb.
So Q4 2025, I'll sum it up with global financial markets performed quite well. We finished the year strongly. Q3 25, Q4 25 basically followed suit. Equities performed well, fixed income, positive, slight positive, not as well as equities, and alts offered diversification across the board. Gold, standout performer. Q1 2026, fast forward in January and February, also followed suit with that train. Equities were holding up, fixed income, things were good. Clients might have noticed portfolios were performing very strongly, especially for such 2 months into a year. And then all came the end of February, start of March, which I think we should probably get into.
Yeah, we'll get into that in a minute. I think, but first thing is we did a change, didn't we, in January?
We did.
Can you tell us a little bit about what that was and why we did it?
It was a small change, but it was one that was quite prudent and important, and we got quite favourable results in the short term. So approaching the end of January, I think the official date for the change was about the 28th, and we were quite concerned in a positive way with how much gold and silver had spiked in price, and we were basically concerned with volatility inside portfolios. So instead of just rebalancing to our neutral weight, we decided to take the opportunity to take a bit of profit, but we also reduced a bit of risk. And by doing that, we basically reduced our allocation to about 60% of what it previously was. At the time, gold was trending towards $5,400, silver at 120. And coincidentally, quite a lot of people across the industry also did the same thing. So if anybody looks at a gold graph, they'll see right at the end of January, the price pulls down, and a lot of that's to do with profit taking. So it was quite a prudent move, reduced risk in the portfolios, took some profit, and it basically helped us going into March when gold didn't perform maybe like investors would have thought.
Yeah, so ultimately we did it about a week before the massive drop in silver as well, didn't we? So it was just taking that profit and allowing us to reallocate that elsewhere.
Absolutely, we took the profit, and we by no means forecasted quite a rapid price drop after we took the profit. But we reallocated into some other areas inside the alternative space. So we introduced an absolute return fund into the portfolio, which is essentially a really low risk multi-asset, very vanilla fund. It's performed quite well since we've incepted. And we also topped up some other positions in global infrastructure and global property.
Okay, great. So now let's talk about, obviously, what's happened from about mid-Feb through to, well, as we sit today, which is the 8th of April.
Yeah. Okay, I'll try and keep this short. 28th of Feb, start of the US-Iran war, caused global financial market chaos because volatility went through the roof. Supply chain disruption in oil caused a huge oil spike, with oil very rapidly upward tracing, went over $100 a barrel, which had huge ramifications basically across the board for financial markets. Interest rate policy was challenged when previously it was thought that interest rate policy was trending downwards. So we'd see cuts. That's across both the US and the UK. That was challenged because inflation was challenged. It was considered that consumers and businesses would have to pay higher costs. Energy, geopolitics was elevated to a level I'd say not quite seen for a long time, but even for current standings, it was elevated. And global growth was therefore challenged because higher input costs, being higher energy costs, has then threatened global growth. Fast forward a month, and it was quite a painful month in markets. Equities took the brunt. Not many asset classes performed well, except cash and oil. On a bit of positive news, we did have some oil exposure in the portfolios. The LNG commodity index, in case clients have ever seen that, we entered a position, I think it was actually the start of March 2025, and it's a broad-based commodity index, and it holds about 30 to 40% in energy and gas. So that's obviously spiked massively upwards, which was nice to see, but you'd rather the whole portfolio was moving up rather than a small segment. But post today, as Tristan said on the 8th, we've seen equity markets, fixed income markets, gold severe bounces to the upside with a 2-week
Yeah.
ceasefire agreement. Hopefully it stands and we'll get some more news. It's difficult to comment with ever-changing daily news, but the portfolio is actually on a quarterly basis, Q1 2026. They did end positive, which albeit was only slightly positive due to the changes made at the end of January with the gold profit taken. They actually outperformed their weighted equity benchmarks relatively noticeably at almost 2%.
Okay, so ultimately, as well, it seems that if we go back to the start of the year, portfolios are still all up,
Yes,
as we talk today.
they are still up today as we talk now, which is a very positive thing considering the benchmark slightly negative. And it's just unfortunate that the year started so strongly with January and February that clients will see a slight
Yeah.
detractor from peak to trough, but overall on a quarterly basis, yes, still positive.
Okay, great. And what changes have we sort of made this quarter to go forward?
We had a big change at the 5th of March 2026, and it was a change probably that not a lot of people will see happening because that's the intention, and it's to do with share class conversions. And in layman's terms, a share class conversion it's a change in pricing of a fund that a client's already invested in, but the change in pricing is to the upside, i.e. it's a cheaper cost for the same thing you're already invested in.
So essentially, it's kind of like if you go and buy something at the moment, if you were going individually to buy it, you pay full price.
Yes,
And we've moved more to we had an institutional pricing before, but now we're almost moving to like an institutional plus,
absolutely.
which means we can pass that saving on.
Yes. So the savings passed on via cheaper portfolio costs, which is then obviously passed on directly to the underlying client. Clients won't notice this so much because it doesn't trigger any gains or anything like that. It's basically a process that happens in the background.
Okay.
And just to give a quick sort of synopsis of it, it's to do with ongoing discussions we've been having for months, to put it bluntly, with some huge fund houses, to name a few. And just a caveat, it's not all the funds inside the portfolio from these fund houses, but there will be correspondence coming out to clients to explain which funds it directly is. But you've got Schroeder, HSBC, L&G, Aberdeen, Fidelity. So you've got huge names in the industry.
Names.
And you're talking across 10 plus funds inside the portfolios that are now a cheaper cost, and they're basically exactly the same thing that the client was invested in prior to the conversion. And some long in a balanced portfolio, I think the fee reduction's about 0.1%, about 10 bips overall, which is sizable.
So if you had sort of say $500,000 invested, that would save about £500 a year in fees.
Exactly. For being invested in the exact same product.
Yeah, as if you were doing it somewhere else and so on.
Exactly.
So it's a nice benefit, and it all adds up over the many years that you're then invested as well.
Yes, exactly that. And just to jump on and sort of reiterate the point, this is due to ongoing relationships, strong relationship with fund houses, the size we've now sort of grown to, and the ability to negotiate on fees on behalf of the underlying client. And it enabled us to have these conversations and access cheaper share classes.
Great. And sort of going forward, obviously we've done a few changes there. We've also changed a couple of funds, haven't we? But nothing major in the underlying sort of fund sort of portfolio itself. Where do we see that going over the next quarter? And let's make the assumption that the geographical issues have kind of finished.
Yeah, okay, fair point. You hit the nail on the head. Not a huge amount of changes being made recently. There's one or two sectors in particular, the global equity income. We currently hold Guinness, and it's been on our shortlist due to performance for about 18 months.
That's not the beer, that's the fund house.
It is good point. It's the fund house, Guinness Global Equity Income. That will be exiting the portfolio in favour of another global equity income fund. But yeah, on a regional basis, not too many overwhelming changes. It's kind of a sit through this period. Going into it, we were -1 equities, which we were happy with that position, and +1 in fixed income.
Okay.
Cash alternatives were neutral. So we were quite balanced approaching, went underweight anything, and it's kind of a sit through this period that almost blindsided financial markets.
Yeah, and ultimately, like you said, we've performed a couple of percent better than the actual benchmarks.
Yes, yeah. In risk 3, 5, and 7, they're just the three portfolios that come to my head. About 2%.
Okay.
That's finishing about the 31st of March, just based on Q1 26.
Okay, great. And so obviously going forward, hopefully things should be relatively smooth sailing as long as we don't have any major
Yes,
changes and things.
putting the sort of like positive hat on, we'd hope these 2 weeks prove beneficial to talks, and just focusing on the financial market implications of this, we get some type of clarity on the direction. Although a ceasefire has been agreed for 2 weeks, we'd like some type of lasting agreement, and I think financial markets will then breathe a wider sigh of relief. We've witnessed one today live in markets. I think you could see that again when there is an ultimate end in some capacity, which benefits the market. The market was very, very much rocked by the surprise and the rapid upward pricing of oil. Hopefully we see it downtrend, which will then give an upside to global growth. It will take away inflation concerns. It'll put interest rates downtrending again back in picture, and consumers and businesses will then hopefully breathe a sigh of relief, I should say, and we should then be concentrating on financial market impacts, corporate earnings, corporate profits, etc., rather than geopolitical events.
Yep. Although it has been interesting that the geopolitical event itself hasn't massively impacted the portfolios. If we look at it over the 5 weeks, there was a big drop and then it's come back since.
Yeah, the portfolios have held their own, riding through it. Ultimately, it's not nice to see a negative event, but on a risk-adjusted basis, they've held their own, they've protected. And if you look on a quarterly basis and maybe don't focus on the month of March independently, they're positive, which is nice to see when such a sudden oil shock has appeared, which I don't believe has been seen since the early 70s.
Not to this size, yeah. Okay, great. Well, thanks a lot, John.
Thank you very much.
So that's our update for this quarter. As John also mentioned, that there'll be a number of letters going out that'll be explaining the cost reductions that have gone through and how that all works. And of course, if you ever have any questions, please contact us on one of our telephone numbers or at our website or our email. So thank you very much.
Cheers.